So Oliver, we've had results reported from a variety of European banks, and we see that last year they were raising capital, and this year they've been increasing their dividends. So what's happening?
Yes, you'd think the two sort of run counter to each other. Last year was all about raising a lot of capital ahead of the stress tests that took place last autumn. And this year, one of the big themes we've seen so far is increasing dividends. So some of the money they've just raised from investors, they're paying straight back out again, which doesn't seem to make an awful lot of sense. But if you look at where banks are and the sort of investment proposition, you can see why they would want to be paying some cash out to investors. They're not growing very much, their returns on equity aren't very good. So dividends is one of the ways they can attract shareholders into their shares. And so they're all trying to increase the payouts as much as they can and as much as regulators will allow them. But it's a very difficult question, a very sort of thin line between what they can sensibly pay out and what will be too much.
So higher dividends, as you say, would appeal to people, but is it something that they can afford or going forward longer term?
So it depends very much on the banks. The banks, after all these many years of capital raisings, are in very different positions. If you look at the Tier 1 capital ratio, this is the kind of core capital ratio under the Basel III rules, the new set of regulations. Some banks are around sort of 10% or just under. That's at the lower end. The better ones are up towards 11, 12, 13% or even more. So the stronger ones who have plenty of capital and plenty of spare capital, there's no reason at all why they shouldn't be paying out dividends. For the weaker ones with capital ratios of around about the 10% mark, you've got to wonder how sustainable those payouts are, whether at some point regulators will tell them actually they have to raise more capital again, or they have to cut their dividends, or whatever it might be. But you have to think, well, maybe those dividends aren't quite as secure as the dividends coming from better capitalised banks.
So then which banks have the sweet spot, the sort of high capital ratios and good yields on the dividends that we think we can rely on?
So there's a few banks who sit in those categories, particularly the Scandinavian banks. A lot of them are very, very well capitalised and have very high dividend yields. So there's a lot of banks such as Swedbank up in Sweden. So there's a lot of those in Scandinavia. Elsewhere in Europe, the likes of UBS in Switzerland and Intesa San Paolo, these are banks, albeit very big banks, they have decent capital positions and fairly reliable dividend payouts. But those, as I say, with capital ratios towards the lower end, the sort of 10% mark, I think they shouldn't really be concentrating too much on paying money out. They should just build their positions to a position where people can sensibly rely on the dividends.
Okay, thanks very much. I guess we'll look and see what comes for the UK banks in the next couple of weeks and see if they follow suit.